In this episode, we are going to continue to talk about liquidity pools. I will break down how to identify direction, range, and draw on liquidity. By the end of this video, you'll understand when and which liquidity level you have to use. So let's get straight into it. So as I already explained the monthly and weekly in my previous video, in this one I'm going to cover the other important liquidity levels. And as you could probably expect, the same concepts apply here on the daily chart. On the daily time frame, previous day high and previous day low become very important external liquidity pools. As you can see here, previous day low frames a reversal while also acting as a draw on liquidity. Price trades into that level, takes the liquidity resting below it, and then reacts. That's the key idea. Previous day highs and lows are not random lines. They're areas where liquidity sits. Price is either drawn to them or uses them to engineer a reversal. So when you mark out previous day high and low each session, you're essentially mapping where price is most likely to seek liquidity next. Simple framework, but extremely powerful when aligned with higher time frame bias and displacement. Now, we won't go through as many examples here because that's what my daily bias video already covered, but let's walk through a few right here. So we mark out previous day high and previous day low. Now ask yourself, is price more likely to draw to this high or this low? In this case, it's likely to reach for the low. And there you can see price trades directly into previous day low. Again, we mark out the new previous day high and low. Now the question becomes, is price more likely to draw to the high or the low? Given the context, probably the low, and once again, price reaches for that liquidity. Here we close back inside the range. That tells us price could reach for the high. But we form a very small doji candle, which shows indecision. In that scenario, price could reach for either side. There's no clear displacement, so I'm not really certain. Then we see price take liquidity on both sides and form an outside bar. After an outside bar like that, I'd like to see continuation higher into previous day high. Because once both sides of liquidity are cleared, price often seeks the next external pool. Here we just barely miss previous day high. So we go ahead and mark out our new previous day high and low. There, previous day low gets taken. Then again, and again. So you can clearly see that previous day highs and lows can be used as a very simple draw on liquidity, or they can be used to frame a reversal. It's basic, but when you truly understand how price seeks liquidity, it becomes extremely powerful. Now, before we talk about session liquidity, it's important to understand when these sessions, or kill zones, actually occur. In this video, we're focusing specifically on the indices kill zones, which are Asia session, 8 p.m., London session, 2 to 5, New York AM session, 8:30 to 11. If you missed my full breakdown on kill zones, I linked that video in the top right. But for now, we're just focusing on how these sessions create liquidity. And similarly to everything we've covered so far, session highs and lows can be used as a draw on liquidity or a framework for a reversal. Each session prints a range. That range creates internal and external liquidity. Once the session ends, price will often target the high or the low of that session. Now, a lot of this ties directly into the daily profile, how the day is likely to expand, but we'll save that for a later video series so we don't make this one too long. So let's hop into the charts and go through a few examples. For this example, I'm using TFO's ICT kill zones and pivots indicator. These are the settings I use. I have Asia, London, and New York. AM selected with the exact times listed earlier. I also have my pivots marked off, but with no text, just to keep the chart clean and focused strictly on price and liquidity. Remember, the tool doesn't make the trade. Understanding where liquidity rests, that's what matters. What I'm focusing on here is the displacement, or the lack of displacement, around these session levels. As we let price move forward, you can see the indicator printing the session highs and lows. Now the Asian range has formed, so our attention immediately goes to this high and this low. At this point, price is failing to displace out of the range. There's no strong expansion above the high, no aggressive move below the low. We're just consolidating. When I see that lack of displacement, it makes me consider the possibility that price may seek liquidity on the opposite side of the range. Then, we get a sweep of the Asian high. Now here's the key. If that high is going to hold, I want to see displacement below the Asia low. And that's exactly what happens. We get strong displacement down through the Asia low. That shift is important. It tells me the sweep of the high was likely manipulation, and now price is expanding in the true direction. The next thing I do is project out the London manipulation leg. We have the low formed here and the high formed here, so I project that dealing range. I'm mainly focusing on the 2 to 230 and 4 to 430 windows to understand where London created its expansion. Coming into New York. AM, ideally I want to see continuation lower. We get a retracement, and there is some minor displacement upward. In that case, I want to see price displace back down through that retracement area to confirm continuation. And there it goes. Price pushes back through it. Notice how that prior displacement area now acts as an inversion level. Price respects it and continues lower. Now that New York AM session has started, we get clean displacement down through our projected levels. So what's the lesson here? The lack of displacement above the Asia high, followed by clear displacement below the Asia low. That sequence gave the indication for what was likely to follow during the New York AM session. This is why displacement around session highs and lows is so important. It's not just about marking the levels, it's about how price behaves around them. So in this last example here, we're going to take a look at NASDAQ on the monthly chart and then work our way top down to an entry. If you notice here on NASDAQ, we are trading into a monthly inverse fair value gap with a volume imbalance. And we closed respecting the consequent encroachment of that inverse fair value gap. So if we're expecting price to go lower from here, where can we anticipate it reaching for? Previous month's low. So with that marked out, let's drop down to the daily chart. Now here on the daily, if you compare this to ES over the same period, you'll notice SMT right here. NASDAQ made a lower high while ES made a higher high, showing a crack in correlation. So with that idea in mind, if we're looking for price to draw to previous month's low, or even this low right here, we want to see some sort of shift on the daily time frame. So let's let it play out. Here we get displacement down and a close below these up-close candles. Ideally, after that displacement, I want to see price retrace before continuing lower. And that's exactly what happens. We retrace into this area and then begin trading lower. Using the next day model, I can now look for price to reach previous day low. So let's drop down to the lower time frames and see how session liquidity plays into this. Here we have previous day low marked out. That's our draw on liquidity. Now let's see how the sessions develop. Right here, the Asian range is completed. So I'm watching for displacement, or lack of displacement, around that range. We get a little displacement out, nothing significant, then price displaces back through the range. I'm not really interested yet. I'm waiting for New York. Now what do I notice? We had equal lows. Those get taken. Asia low gets taken as well. So likely we come back into the range. Now New York AM session begins. Our draw on liquidity is still previous day low. So ideally, I'm looking for a stop run and displacement lower to get short and target that low. Here we sweep London high and get displacement lower. With that, I track an OTE of this range. I want to be tagged into OTE, stop above this high, and target previous day low. Price retraces into OTE, then trades lower. And there we go. Previous day low gets hit before a reaction. So you can see how we went from the monthly to the daily to the lower time frames, aligned them all, identified the draw on liquidity, and then used the sessions to organize an entry and target that liquidity. That's the full top-down alignment. And that's going to conclude this series on important liquidity levels. We started at the monthly, worked through the weekly, refined on the daily, and executed using session liquidity. Everything we covered comes back to one core idea. Price is engineered to seek liquidity. Previous highs and lows. Session ranges. Equal highs and equal lows. Displacement and reversals. None of it is random. When you understand where liquidity rests, and you wait for displacement to confirm direction, you're no longer chasing price. You're anticipating where it's likely to deliver next. That's the framework. That's the alignment. That's the model. If you followed through this entire series, you now have a complete top-down approach to identifying draw on liquidity and organizing entries around it. Study it, backtest it, make it your own. I'll see you in the next one.